You do everything right. You pay your premium on time, every single year, for decades, specifically so that if disaster ever hits your home, you're covered. Then one letter arrives, not from a storm, from your insurance company. They're leaving. Not just raising your rate, leaving your state or your zip code entirely before the storm even has a chance to show up. And they're not the only ones doing it. Insurance companies will tell you this is simple math. Climate risk is going up, so premiums go up, and in the riskiest places, insurers just can't make the numbers work anymore. That's not exactly a lie. Wildfires, hurricanes, and floods really are getting more frequent and more expensive, and homeowners in the highest risk zip codes now pay 82% more than those in the safest ones. One Wharton School economist who studies climate and real estate put it bluntly: private insurers simply don't want to write policies in the riskiest areas anymore. And in places like Florida, this market has quietly been broken for years, not months. If that were the whole story, insurance would just be getting more expensive. It isn't just getting more expensive. In a lot of places, it's disappearing. State Farm, one of the largest home insurers in the country, stopped writing new homeowners policies in California entirely, citing wildfire risk. In Florida, 9 different insurers failed completely between 2021 and 2023. Florida, Louisiana, North Carolina, California, and Massachusetts now have the highest rates of non-renewal in the country. Even states that never make the headlines are following the same script. Georgia is projected to see one of the largest rate increases in the country this year, driven largely by sudden, storm-driven flash tornadoes, and insurers there are already quietly scaling back in the hardest-hit corridors, long before most homeowners even notice. Insurers are required to give homeowners written notice before dropping them, usually somewhere between 30 and 120 days, depending on the state, which sounds protective, until you remember that finding a new policy in a market other insurers have already fled can take a lot longer than that. And this isn't staying near the coasts anymore. The same pattern is now showing up inland, in states like Iowa and Oklahoma, driven by severe storms most people don't associate with an insurance crisis at all. Part of the reason is that hurricanes themselves have changed. Storms like Irma and Ian caused their worst flooding damage hundreds of miles from where they actually made landfall, which means the old assumption that only coastal properties carry real storm risk is quietly becoming outdated. So if private insurers are leaving these markets, what happens to the homeowners left behind? They don't just go without a house. Most of them get funneled into something most people have never heard of: a state-backed insurer of last resort. Florida created its version, Citizens Property Insurance Corporation, after Hurricane Andrew bankrupted close to a dozen insurers back in 1992, in what was, at the time, the most expensive storm in American history. It exists for exactly one reason: to cover homes that private companies have decided are too risky to touch. It was designed as a temporary backstop, something to hold the market together until private insurers came back. Decades later, in the highest risk parts of the state, it hasn't shrunk. It has quietly become one of the only real options left. Which sounds responsible until you look at who actually ends up inside it. These last resort programs end up holding a hugely concentrated pile of the worst risk in the entire state, precisely because every private insurer already declined it. Private companies get to keep writing profitable policies on safer homes. The catastrophic, expensive to insure properties get pushed onto a public program that was never built to absorb that much risk at once. And when one major hurricane or wildfire season actually hits, a program like that can come up short fast, which typically means either a state bailout or a surcharge added to insurance bills across the entire state, including people who don't live anywhere near the disaster zone. To be fair, insurers aren't purely the villains here either. Part of why so many left Florida in the first place was a wave of inflated litigation and roof replacement scams that drove up costs faster than regulators could track. Insurers argue that pulling back was simply how they stopped the bleeding. To be fair as well, regulators aren't just standing by. Florida has passed reforms limiting certain lawsuits against insurers and mandating flood risk disclosure. California recently allowed insurers to price policies using forward-looking climate models instead of relying only on decades-old historical loss data, which should, in theory, convince some insurers to come back. It's a real attempt to fix the underlying incentives. It just hasn't caught up to the pace of the losses yet. And even the insurers who don't leave outright are quietly doing something similar.
Some have started limiting
exactly what a standard policy actually covers, carving out the most expensive disaster types with separate, much higher deductibles or straightforward exclusions. On paper, you're still insured. In practice, the coverage that used to be included is quietly shrinking too. In the meantime, the gap is being filled by people simply going without coverage at all. One nationwide analysis found roughly 1 in 13 homeowners now carries no insurance whatsoever, leaving over $1.5 trillion in homes completely unprotected. And the burden isn't spread evenly. Homeowners in the riskiest areas aren't just paying more, they're also being dropped for missed payments at higher rates than everyone else, which means rising climate risk and rising insurance costs are landing hardest on the people who can least afford to absorb either. None of this is happening on a blank slate either. Decades of housing policy already pushed lower-income families disproportionately into the neighborhoods most exposed to flooding and extreme heat. So when insurance costs spike sharply in exactly those areas, the gap between who can still protect their home and who can't gets wider, not narrower. There's also a knock-on effect most people never think about until it happens to them. Mortgage lenders require proof of insurance to issue or maintain a home loan. So in areas where private coverage has quietly disappeared, this stops being just an annual cost problem. In the worst cases, a home becomes difficult to sell, refinance, or keep financed at all, whether or not anything has actually burned down or flooded yet. In the Los Angeles area alone, close to 250,000 homes sit in wildfire risk zones, representing more than $180 billion in potential rebuilding costs. Climate change has already been linked to a rise of more than 170% in the total amount of California land burned by wildfire compared to a world without that warming. And insurers are pricing that shift years before most homeowners ever feel it. Step back, and the shape of this is familiar, and not just from insurance. It's the same basic pattern that shows up whenever an industry finds a way to keep the reliable, profitable customers for itself while quietly routing the catastrophic losses somewhere more public. Private companies keep the safe business. The public safety net absorbs the disaster, usually only once it's too late to price it properly. Nobody has to make a single dishonest decision anywhere along the way for that outcome to happen. The system just quietly sorts winners and losers, zip code by zip code, and the sorting happens well before anyone's house actually burns down or floods. So the next time your insurer sends a non-renewal letter dressed up as a routine business decision, remember what's actually being decided. It's not really about whether your home is insurable, It's about who was always going to be left holding the risk, quietly, long after the money had already moved somewhere safer. Subscribe if you want to keep learning how the safety net under your own home actually works.